Good morning, Mayur. Thank you so much for taking time out for our first series on the industry, healthcare and life sciences, and the M&A and fundraise trends and outlook. We're really glad to have you with us.
Thank you, Vishal.
We would love to hear more from you on what has been your journey. So we have Mayur Sirdesai with us, who is a founder and a managing partner for Somerset Indus Capital, which is the healthcare and life sciences only focused private equity fund in India. Was set up in 2011. So been there for 14 years. So Mayur has more than 30 years of experience in healthcare, pharma, FMCG sectors.
Sure.
He's done his education from IIT Mumbai and then a couple of degrees from the US, right? So Mayur, if you want to give any further update on your background before we move into the questions.
No, thank you, Vishal. I think I'll just probably sort of elucidate a little bit about what Somerset is. So Somerset Indus Capital Partners, we've sort of created a healthcare-focused private equity fund, but with a little bit of a differentiator, which is basically saying that it creates access to affordable quality healthcare, but focuses on good returns, but also strong social impact within an ESG framework.
Yeah.
I think that is the sort of play which we have. And I think what we've learned over a period of time is, as we operate in the lower tier markets, how to work with different lower price points, lower efficient cost structures to deliver those good returns. So I think that is what probably differentiates us even within healthcare funds in India.
Yeah.
But I think that's the positioning that we have in the market. I think that's where we are.
Excellent. And before we get into the detailed questions, any specific reason you chose healthcare when you started Somerset?
So I mean, both me and Avinash, who's my co-founder, I think we are from healthcare backgrounds. We are childhood friends, but had different careers. He's been a private equity in healthcare in US and Europe for 30 years before we formed the fund. My background is my pharma. My family is a pharma family.
Okay.
So due to which by default, though I was an engineer, did things beyond pharma, but sort of came back to India and sort of got into pharma. So I've been an entrepreneur in pharma. I've run my own manufacturing business for about a decade.
Oh, okay.
And then ran IMS Health's consulting business for about 5 years. So I have an experience of sort of across entrepreneurship, professional careers, across manufacturing, marketing, advisory, consulting, all this space. So I think that led us to sort of look at what do we do when Avinash and I sort of connected in 2010-11.
Yeah.
We said, how do we really bring our experience to bear? We were actually looking at operating businesses to build out in healthcare. So something which we did later in the fund, which is like dialysis clinics or hospitals, etc. But the more we looked, we realized there are enough promoters on the ground building things in the SME sector. They needed support. And in those days, a $5 million check was not easy to get in sort of private equity.
Yeah.
And I think we said, let's look at that as an option where we will support promoters, not just with capital, but with our experience on the ground. And that's the thesis which we built the fund. And even today, I think that thesis holds. I think that was the logic by which the whole thing started. So it's a very different way from probably what more other funds have worked with. I think it's basically the fact that we've been in this space for 30 plus years, both of us. We said, let's look at probably the next stage of what we do in healthcare, though we've done anything else. I think that was how it played out.
So you played a role of, you be the part owner of each of these investments over the years. No, that's really impressive, Mayur. So thank you for sharing that. So maybe we'll start with the first question, Mayur. You've been associated and partly you've maybe addressed it, and some of it would love to hear more about it. Has there been a major shift in the way you've been investing? So you've been investing for almost 15 years. How has that, if there is a change, how has that evolved over the years in terms of how you select the companies? What are the 2 or 3 really important criteria that you look at even before you start getting into a discussion for a diligence selecting a company.
Got it. Yeah, I think there have been significant changes over the last sort of maybe over a decade. Well, what we saw when we started out was a healthcare market which was relatively small.
Yeah.
About $80 billion market that time, predominantly pharma, to some extent hospitals. Rest of the sectors were very much smaller. I think a decade of being in this space, the market has evolved significantly where the market grew by $300 billion in that period.
Right.
Obviously, pharma did well, but hospitals became big. Even sectors like diagnostics, especially post-COVID, became big. Things like MedTech, etc., started picking up because hospitals picked up. So MedTech is sort of a lag to what hospitals scale up. That happened. Primary care, preventive care, again, after COVID became something. So even though insurance wasn't in play, people started focusing on their own health and sort of that play. Also, affluence in the market also led to that. But I think all this led to sort of many more sectors sort of coming of age. I think what we've seen over the last decade is a very different play now. India has been a self-pay market all along.
Yeah.
And if whatever growth models were always built with self-pay in mind, I think that has changed to say, can we look at insurance? And there's insurance both in the private sector which came in, but even the government stepped in with the Ayushman Bharat schemes, the PPPs, etc. And that has led to a very different level of scale. And going forward, the projection is that in the next 5 years, from 22, 23 to about 27, 28, you're going to add another 300 billion. So what we added in 10 years, we added in 5. And this time you're going to see every subsector scaling up.
Right.
And that is the opportunity. I think that is the real change which has happened in the market. And that's why I think investing things, they have changed. I mean, where we were looking at a $5 million check in a company about 20, 50 crores, that same company today is a 100, 200, 300 crore company.
Yeah.
So you're looking at a very different company. We're still the first institutional capital. So across the board, we've been the first institutional capital.
Yeah.
But this institutional capital now is available at a much different scale of
Yes, you've seen a lot of control-led transactions also now happening.
In fact, we still do minority. And I think at this stage, you still can do minority. But now when you see somebody cross 500 crores or 1,000 crores, it's typically a controlled transaction which is taking place. So the market's evolving. I think the market's evolving that we're seeing larger minority transactions.
Yeah.
You're also seeing majority transactions as people sort of say, we don't want to remain in healthcare, we want to move out. There are controlled deals which happen. We did a deal where we sold Cygnus to General Atlantic in a controlled transaction. So those kind of things you're seeing. In fact, we participated in Sterling Hospitals, which was a controlled transaction again. So yes, you're seeing that phase, which is typically the maturity of a private equity's life cycle.
Which also shows the confidence in the industry, right?
Exactly.
But in terms of your core thesis, while minority still remains your core thesis, you still want to stay close to the promoters, help them beyond capital. Has there been any shift in how you select a company for investment beyond, other than the opportunity? The market opportunity, as you rightly said, is expanded significantly. But any one or two key sort of considerations that you would have?
So I think you have to look for promoters who can execute at scale.
Right.
I think that is the critical part. See, we are minority investors. We're supporting a promoter. We may do everything beyond it to support the promoter, but finally you're betting on his execution capability.
Correct.
And now you're talking about execution capability which is very big in scale, right? Earlier we were looking at a 20, 50 crore going to maybe a 200 crore.
Yeah.
Now you're talking of 100, 200 crores going to probably 1,000 crores.
Yes.
Now that's a very different value in terms of numbers. Right. And I think the ability of the promoter to really execute is important. So that is where we spend time. In fact, we like to work with deals where we spend time with promoters early enough and for some time so we understand this piece with him.
Yeah.
Because that becomes the critical piece of anything. I mean, more than the business, which you're obviously betting on and underwriting, I think the critical part is I think finding the promoters. And promoters, you have to understand, now at this stage, they're much more mature. They're much more, they have a very set idea of what to do. How do you really work with them? And then I think the ability to say, can the promoter really, has he built an organization already? If he hasn't, then is he amenable for that?
Yeah.
I think all this plays a role because it's at the scale at which we are coming in now, he can't do it on his own.
Correct.
I think that plays a role.
Just to sticking to that point, Mayur, how important is governance, both at the organization level and also at the founder level, right?
So it is important. So I think it's we do our integrity checks formally. We do our reference checks to our networks. All that is important to see how the promoters are.
Yeah.
But I think as part of diligences, all this is covered too.
Yes.
And then when we actually invest, we have enough affirmative rights, etc., which will govern that.
Yeah.
But I think the critical part in all this is the relationship building with the promoter.
Yes.
It's all this thing sets up well because it's rest of it is on paper, but your ability to build that relationship with the promoter, I think, is very, very important to sort of make sure that all this falls in place, because you're not really going for the worst case scenario. You want to grow the company and
Yes.
work with him. So I think that confidence level, and I think that's what we've always done. We've gone into a company and said, okay, what can we do for you? And we will open up our networks and everything to him upfront. And sometimes the deal still doesn't happen, but we're okay with that. I think that helps the ecosystem. But we will always make sure that we are out there first saying, how can I help? I think that plays out.
No, I remember that in one of our last conversations with one of the promoters we had together, and you clearly said you want to engage with the promoters early, know them early, even if the deal happens, doesn't happen.
Sure.
But your comfort on the promoters is more of utmost importance. No, I think this is quite helpful. So I think since we're sticking to the point of working with promoters, you want to share your experience of how much flexibility you've had or you've sought from your investee companies, and how has that relationship worked with the promoters in the past? Because one is access to capital, right? The other is what else does Somerset bring on the table?
True.
And how do you set that expectation upfront when you invest in a company?
The way I look at it is that how do you really work with promoters is different for each promoter. I mean, each promoter has his own strength.
Yeah.
And you're basically backing them. So bringing in complementary skills. So nowadays we spend a lot of time working with promoters in supporting acquisitions.
Yeah.
It's not something they've ever done.
Yes.
We will spend a fair bit of time making sure that those things happen, then the integrations with when the acquisition comes on board, because that is a skill set that they don't have.
Correct.
Once they've built it, they will go ahead and they know how to do all that. But I think wherever they need skill sets, so in other places we've jumped in and said, okay, so they need some talent which is they can't bring on board. Can we, because of our networks, bring them on board?
Yeah.
So those kind of things. So other times we'll spend time working with the promoter to build the organization, and that's a long-term exercise.
Yeah.
I mean, these are very strong execution promoters who believe that they can do everything.
Yes.
How do you convince them that, yes, this is not going to work forever?
Yeah.
And I think a lot of times they come to us at a time saying, now we understand why you're saying this, because now our personal bandwidth is getting consumed. I don't really have anything left. So then they start looking at it. But you have to keep seeding the thoughts. And a lot of these things don't happen. I mean, I always look at the best promoters listen to you extremely well.
Yeah.
But they will do it at the time where they feel it is right. So you just have to keep building that trust and that path. They will do it. And I think that becomes a critical path to support their execution. Say, what they can't do, can we get in there, build it out for them? And like I said, it's talent, it's strategy, it's networks, it's acquisitions, compliances, the whole systems and processes around it. All that is that. So a lot of times ESG is a new thing for them.
Yes.
How do you really get them fully compliant on that? Them understanding impact as part of it. So we help them measure impact also. All that changes their way of thinking. So it's no longer a saying that I'm just building a business, but that it's more holistic in nature.
Yeah.
I think that plays out.
It's also building trust.
Yeah.
As you rightly said, it happens over a period. But more often than not, there is resistance from the promoters because of your minority stake, or you've usually seen most promoters ready to sort of engage and cooperate.
So I think that piece has to be understood fairly early. Saying when you're getting into a company, whether these guys are going to work with you in a certain way, and is there comfort. Now even for them it's the same thing, right? So a lot of times they will reach out to healthcare is a small place.
Yes.
I mean, they will reach out to our portfolio companies and find out how we work with them.
Yeah.
We've seen times where we are at another portfolio company and this promoter calling up and saying, should I sign up or not?
Yeah.
Now, this is the trust, right? I mean, I think understanding that early to say whether this will happen or not is very important, because you're talking of a 5-7 year journey with a person.
Correct.
If you don't get it right upfront,
yeah.
it's not easy to change the behavior later on.
Yeah.
So I think that is a critical part, identifying the right promoters and making sure that they can sort of collaborate, work well. I think that's important.
Yeah. So talking briefly, Mayur, we said early, you see the industry going through a major shift. It's already started moving because of different reasons, right? COVID being one of them, and then digitization also has a role to play. So where do you see the industry heading in next 3 to 5 years? You talked about some numbers, adding $300 billion.
Sure.
So maybe if you can spend some more time in terms of the future trend, are there any specific 2 or 3 sub-segments that will do better or excel much faster than some of the others? So for example, you keep hearing about hospitals. There's many more hospitals that are coming, single specialty, multi-specialty. So we'd love to hear more on what are the sub-segments that you see will drive a much faster growth and a multiplier growth.
Right. So we are bullish on the entire industry. I think the healthcare market is really at a point of inflection where everything is picking up. But I'll sort of pick out certain things across sectors. So if you see pharma, I think one thing is definitely playing out that the branded generic play is sort of slowing down because of scale.
Yeah.
Right? There's no more new products to launch. What's really going to come through is the biotech products. And I think getting an understanding of biosimilars, biotech products, because that's the prevalent sort of play which is going to be The other thing I think in pharma is going to be more consumer-driven plays, because right now it has always been a doctor-driven play. I think how do you really build a consumer-driven play? That is.
You talk about nutrition, is it?
Not nutrition. Even see, there is enough products which are OTC, which don't go OTC because OTC requires a different kind of skill set.
Correct.
And pharma doesn't necessarily have that.
Yeah.
Now, can you get in people who can build that whole piece like has done or earlier he had done? If you get those kind of guys who can build the whole media piece and around in advertising piece, you can get a very different business to build. There are enough products legally OTC which still don't go OTC because people just don't want to take it that path because it's a difficult path to take. I think those kind of plays will play out now in India because otherwise it's a hyper competitive market when you're going to a doctor.
Yeah.
I mean, you have thousands and thousands of people in the field who are going to doctors and meeting, and today the large guys have got like 5,000-10,000 people in the field.
Yeah.
Now it's difficult for a 500-man field force to compete with a 5,000-man field force. So then you need to do newer channels to get out to. I think these are playing out. I think the other pitch is playing out is the whole generic play.
Yeah.
The government is sort of pushing, saying, we need to have more generics. You see in the lower tier, low affordable generics playing out. Again, that's a different model.
Yes.
We are looking at those trends now to build out. Now, if I take hospitals, I mean, if I have to see the evolution of pharma and said, what happened in pharma? You started with acute care, then you went to chronic care, which is typically cardio, diabetes, neuro, then you went to super specialty. We're seeing a similar play in hospitals. You're seeing a multi-specialty hospitals, now you're seeing, single specialty, and you're going to see a lot of that. And one of the things which I always say in healthcare is, there is nobody who's going to say, I'm going to control the market. I mean, if you see pharma, this is the most mature piece, right?
Yeah.
25 billion domestic market, 300 companies control 80% of that. Now, and nobody has more than 7-8% market share.
Yes.
You're going to see the same thing every year. So people tell me, diagnostics, so there are 5 or 6 chains. We built one. There will be 100 chains.
So you don't think the consolidation will happen?
Consolidations will happen, but there's so much room to grow.
So much room for new players also to come.
I mean, in services industries, why is consolidation happening? Because the larger players, though they've all grown in a certain market, to go to the next market, they're not going to be able to grow a business on a greenfield basis.
Yes.
So it's the easier ways to acquire. That's what you're seeing, but that doesn't mean that they are covering even one city and saying I have 80% market share there. That doesn't happen. So I think that's why in pharma there are enough, in healthcare there are enough opportunities for you to go and build, because if you cut and slice the Indian market in various ways, you still find a slice which is big enough
So
to get
demand is always still
it's
huge
there.
demand,
It's
right?
there.
And
So-
awareness is increasing. Tier 2, Tier 3 cities, access is increasing.
So I mean, if you see like MedTech, right? It was nowhere at one point in time. It was like $2 billion when you started out. It's going to go to $50 billion by 2030
In India.
in India.
Wow.
You're going to see manufacturing. So even if I say a 90% import market going to say a 60% import market, a 40% of a 30-50 billion market is 12-15 billion, which is today's entire market.
So when you say medtech, we're talking about devices largely?
Equipment, devices, consumables.
Right.
And I think you're seeing that whole. So we've got a thesis that MedTech will be what happened in pharma when it grew. Indian players and distributors, sales guys, all that chemists built to Indian pharma space.
Yeah.
We're seeing a very similar place. Distributors becoming manufacturers, building their own brands.
And these are devices mostly imported, or you think there is a lot of growth, local, domestic?
There's a lot of
manufacturing
focus
also.
on Indian products now, because when you're going lower tier, affordability is a challenge. So unless you build the right products, so there's a market for high price products.
Yeah.
There's a market for lower price. You have to basically see which play you're going to market you're going to operate in.
Yeah.
And I think that play, and that's why we believe, just like what happened in pharma, you'll see a medtech play happening.
Yeah.
Diagnostics, obviously, you've seen diagnostic product services picking up. Primary care, preventive care. I mean, that pace has not even started. And that play, technically, a primary care market is 5x of an inpatient hospital market. So you've got so much to do. And that is where the real digital play, insurance coming in, OPD insurance is coming in. It could be a very different. And that space, we're very excited because it's a new space.
Yeah.
And I think if you invest at the right time in that space, you're seeing this.
So you're talking about more preventive care?
It's preventive care, primary care, screening. So even the government spends a lot of things on screening. So like TB screening is there, breast cancer, cervical cancer screenings.
Do you think someone like is in that space? Yeah. So good. That seems quite exciting in terms of the future outlook, Mayur. Now, we talk about the exits. Mayur, you've invested in 15 plus companies over the last 14 years. You've done multiple exits. Any two or three key takeaways that you would want to share with us in terms of what really worked really well for you in some of these exits?
Sure.
And how you were able to create value along with the promoters in the businesses.
Got it. I think exits are technically opportunistic. I mean, there are 4 exits which you have, right? You have a IPO, you have a strategic, now you've got strategic or a buyout, I would say.
Yeah.
But then you've got another financial investor coming in, or maybe a buyback.
Yeah.
I think we've seen pretty much everything in our portfolio across whatever 7-8 exits we've made. We've had this whole gamut play out.
I like the point you made. It has to be opportunistic.
So the key is timing it, because, and we've had this where we've said no, okay, we'll wait it out, maybe we'll get a better return, and sometimes it doesn't happen.
Time it. Yeah.
So you take it. See, ultimately as a investor, I have to return capital in a certain finite amount of time.
Yeah.
Technically, the philosophy which we go as a fund, and many go as a fund, is that every 5 years, sort of, you raise a new fund.
Yeah.
Right? By the time you raise the next fund, technically, can you return the capital at 1x of DPI at that point in time? Now, that's a balancing of your portfolio. Sometimes you will have to take an early exit. So it's also how you build the portfolio, because as you're building the fund, between like first close and the final close, you have to make 2-3 investments, because these will play out in terms of when you're really exiting, right? So that whole timing issue comes up. But I think you have to go in with a thing that can you return, say, 0.75 to 1x DPI for your fund. To that effect, what exits can you do? Which ones will you sort of stretch for getting higher returns? Which ones will we do for IRRs? And which ones will you do for DPI? And I think that balancing is the critical part. And I think over a period of the last few years, we've started focusing on that more and more, because it is important. You can't just say an exit is going to happen and, I'll just, I want a certain return for it. You have to look at the entire portfolio and say, how is this portfolio going to be?
Positioning.
It's positioning and sort of managing the portfolio to make sure that you're optimal in your returns.
You've had one company going through the IPO or a couple of them?
So that's been a great exit for us. I mean, we took a company which was 35 crores, very small in size, doing pretty much private sector and a little bit of PPPs, and scaled it over 5 years, 5 to 6 years, to about a 450 crore company when we took it IPO. And today probably it has about 700 crores. So scale which has come.
IPO happened what, last year or 2023?
2021. 21. So this is also a business which in PPP is a government business which in COVID literally fell off a cliff. But then he became the second largest COVID testing player in COVID, built up that piece, and when the market turned again, he could rebuild his piece. So you've seen a promoter who is, I have this phrase which I say, promoters have to be restless and resilient. And I think you need that resilience piece, because if this kind of thing happens, if the promoter is not ready to shift gears and sort of adapt, you could be in trouble.
You need to be agile.
So I think it has been a great exit because it all worked well. I mean, the scale of the business, we managed to get into the PPP space. We timed it well to the IPO market at that time. So all those things worked.
Even your exit from...
Like I said, I always say, that was our best exit. I consider as our most satisfying exit, because this is the company we went early. This was a learning experience. I mean, we betted on the lower tier hospital space.
Correct.
Maybe we betted a little earlier. It's because the market was not fully ready. But we knew that this market was evolving, and we had to find ways to really build scale in this business, because just working with cash paying patients in lower tier did not work. So we had to bring in schemes. Then Ayushman came in, but in the meanwhile the business expanded too rapidly. It was really struggling. We stepped in as investors, brought in teams, turned it around. We brought in as a strategic investor. So we did all that to the point that we went from a 30 crore business, 3 hospitals, 2 in Delhi, 1 in Haryana, to when we exited, we were about 21 hospitals, doing about 600 crores. Now that's the scale. Now what we proved is that you can build a scale in lower tier markets, and you can build a profitable business working with whatever is on the ground, which is the payer mechanisms on the ground. I think that has been a real learning experience, not just for us, for a lot of others. There are a few other funds who've done that in USA. But I think for us in North India, we were probably the first guys to do it.
And this was also supported, a lot of their business was also supported by government schemes like Ayushman.
So Ayushman did make a difference. But see, what does a government scheme do? A government scheme basically ensures that you're getting a volume of patients, right? Which otherwise you would require a significant amount of marketing and promotion to get. I mean, typically the CAC, which they call, right?
Correct.
You don't have that issue, but you're working at a different price point.
Correct.
Now, how
price is capped?
It's capped either through like Ayushman and schemes. A PPP, you bid a contract which is again the lowest price. Like the question is, how do we work cost structures? I think what we've done relentlessly is efficiency and costs. Because at that price point, you have to be able to deliver quality healthcare. And I think that is the key. If you ask me what is the secret sauce, it's understanding the cost structures to make sure it works. And I think that we've done across diagnostics, across hospitals, and we've replicated it. What we did then we did this in. Now we're trying to put that same thing together. So I think that's because see, the nature of the Indian hospital market today is that many states are going into schemes. And it's no longer something you can wish away. And it varies. There are certain states, we've seen other states where in spite of them being lower tier, a lot of cash paying patients still come there. The geographies are different. But if you've invested in a certain geography, then you need to adapt to that geography to say what's going to make it work. I think that's the critical part.
No, so you beautifully said that point around the whole cost of acquisition. With this Ayushman Bharat, the cost of acquisition is almost negligible, right? But on this cost drivers, Mayur, what has been the role of someone like Somerset in working with the promoters, or is it largely so in terms of contribution or active role?
No, so we sit down with them constantly to see what cost structure. And now through our experience, we know what works and what doesn't. So we'll sit with say this works. So maybe in this market, you need to put a fixed cost doctor You can't have a variable cost, so you bring down your cost of dollar. You make sure that the cost of you put in generic products, you don't put branded products, again consumable. So there are certain drivers which basically make sure that your costs can be kept in check. And I think that is the critical part. I mean, like in we've done this very well. We've said there's a private cash paying patient, there's a scheme patient. Now doctors consult fees, generic medicines, consumables, all that gets differentiated to basically match that price point, and that has worked very well. And doctors have adapted to it. I mean, initially doctors said, "Oh, we can't do this," but then at some point they realized that that's the patient flow which is coming. Then how do we have to adapt to it, and they've adapted very, very well to it. So this is I mean, it was a market where we knew it was more schemes. Rajasthan was a market where it turned from private to scheme, and you have to adapt. I think the key in healthcare is constantly being able to adapt to the situations. And remember, across the board today, there is a pricing, downward pricing pressure. So whether it is pharma, whether it is MedTech, hospitals,
you have to control the cost drivers.
You have to. So, I mean, the greatest example is pharmaceuticals, right? Where they've constantly kept being more efficient and optimizing APIs, intermediates, everything to basically still deliver a 15-20% EBITDA in spite of cost controls being there for so many years. I think that same thing is playing out in all these other markets.
Interesting. And any major change in the LP expectations over the years? I mean, obviously the industry has been growing, so there's a lot of headwind, but any changes from the expectations from the
So LPs? I think now it's a lot more focused on DPI.
Right.
Return capital being returned. I think the concept of MOCs and multiples of capital and your valuation, all those things are not playing out anymore.
Right.
I think it's very clear how much money are you returning to me. That is the biggest driver for everybody now, and like we play even in the impact space, right?
Yes.
So it's no longer saying, "Oh, I'm an impact fund, so I can deliver less."
Correct.
They want good returns with good impact. That combination has to work, and that's where working those price points becomes very, very important, because you're not going to, if you're going to just deliver impact, you'll never deliver returns.
Correct.
So I think balancing act is very, very, very important at this point.
Correct. No, I agree. I think impact investment doesn't mean it doesn't have to be a business, right? So, okay, and just one more point, Mayur, since you've been investing for the last 14, 15 years, have you seen any major gap in the valuation expectations in the healthcare sector vis-a-vis some of the global trends? If you have any perspective,
I think
is it
Indian
expensive
healthcare
in India?
Indian healthcare is very expensive.
Yeah,
I think Indian healthcare, because it's a growing market, and also the fact that, see, earlier, maybe 10 years back, healthcare was a very defensive sector. Healthcare and consumer were sectors where other sectors weren't performing well, people would run in droves to this market. I think that has changed. I think healthcare is a growth story.
Yeah.
And if you see, most funds have a fair bit of healthcare in them, because it's a good story which has got exits.
Yes.
I think that results in the fact there's a lot more focus this side, which means that obviously valuations are expensive. And if you see, not just in the private, if you see public market valuations are expensive, because in healthcare beyond pharma, there are not that many listed assets. Hospitals are getting there, but it's still not as many as you would like. So I think that results in the fact that there is a much more larger valuation sort of premium on it.
Yeah.
But I think what we've always said is, and like I said, this comes from the fact of saying there are enough companies in every subsector to invest into. The idea is be patient. The idea is to make sure that the valuations you come in is right, because finally your exit valuation and your exit multiple is based on what you came in at.
Correct.
So I think that has been the critical part, saying don't be worry about frothy valuations.
Correct.
Sometimes you will miss subsectors based on the fact that it is frothy.
Yeah.
So a good example is one of our better exits, but we've not done diagnostics because the valuations were frothy. Now we're getting into sort of diagnostics again. So that's sort of our approach.
Yeah.
But I think many times in Indian valuations are way more than what you would pay outside. But we we keep comparing. We've got associates who run funds in the US, etc.
Yeah.
So we will keep comparing what that sort of play is. But Indian things are expensive as compared to
Will
others.
continue to stay with the kind of
It
growth
will.
we see.
I think see it's a growing market, right?
Correct.
There are opportunities, and like I
And
said,
underpenetrated, right? The
it's
industry is still-
underpenetrated. Not too many scaled assets still.
Yeah.
I think that plays out.
So last question from my side, Mayur, is, and you spoke about it briefly earlier also, how important is ESG? And when I say how important, it's also in the context of real action happening on the ground. How do you measure it for some of your portfolio companies?
Sure.
So if you could share some thoughts on that.
So I think ESG has been sort of part of our framework since our second fund, because a lot of it got governed and sort of embedded because of the fact that we have DFIs on board.
Yeah.
And all these DFIs have sort of ESG impact mandates. But I think for us, since that point in time, we've got a very strong, robust framework of ESG on our side. I think it's one of the more comprehensive ones because we've got like IFC, ADB, AIB, NDB, all these guidelines in place. But I think we sort of work with our LPs a lot to make sure that these things are in place. So we have dedicated
At the fund level.
At the fund level, we have our own ESG impact people.
Right.
Our portfolio companies have to have those so that they constantly sort of monitor this. They have to actually, as part of our DDs, we do a very comprehensive ESG DD and impact sort of metric measurement, which then is carried forward in a ESAP policy which they adopt, and then we monitor it as we go along.
Is it included in this condition subsequent or CPs? Or
It is. Yeah. So it's included in that, and so we also release every year. We release a impact report, which will have both ESG impact metrics.
And you measure those matrices.
So we have the whole process now is you set goals going forward and sort of see how every year you manage those goals. There are ESG goals, there are impact goals. So typically for us in healthcare, we are looking at accessibility, affordability, job creation, innovation, quality, and how. But in this, there are qualitative measures which work out. So I think it's an important piece. I think it's very good for a company doing it because it sort of differentiates itself. It creates a very organized player. So in many cases, what are we doing? We are basically building a scaled asset,
correct,
but which is organized in its sector.
Yeah.
So one is financial systems, financial processes, governance, all that, and then you've got this whole
guardrails and
exactly. Yeah. So I think that sort of sets the company up better even when it's going an IPO or scaling up, or even larger funds when they look at it. It's a different asset to look at because it's got all these things already in place, right? So it makes a big difference.
Excellent. So thank you so much, Mayur, for your valuable time.
Thank you.
Maybe before we close the session, any last one or two comments on the industry? I know we've spoken a lot about the growth momentum that we are in. It is further going to strengthen. If you want to share any last one or two comments for us and more on the outlook of the industry and the M&A activity. Happy to.
Yeah, I think we are bullish on healthcare.
Yeah.
I think it's across the sector. We see growth. It's a great time to invest in healthcare. But I think one of the critical parts is that we always tell our portfolio companies also that is be measured in what you do. Yeah. Be patient. It's a game of patience. Yes. I always say, healthcare is not a positive need. It's a negative need. People do fall ill.
You already have a demand.
But you cannot force people to fall ill, right? So there is an intrinsic demand coming in.
Correct.
You have to got to work with that.
Correct.
And it's like in sort of clinics or hospitals, people say, oh, well, let's build 5, let's build 10 and 20. It's not that. You have to basically make sure these assets work well, you get patient flow in. So it takes time. Even when you set up manufacturing, it's not as simple in pharma and MedTech to set up manufacturing because it's not just setting up manufacturing but getting certifications done on both the manufacturing sites, the products. So it takes what would take probably 1 year. It's 2-3 years to do that. So you have to be patient to make sure that. So guys who've been in this field understand it. Sometimes people who are not in this field force things through because they say, no, this works in other industries. I think the idea is to be patient. You will get your returns. I think it's a industry which gives fairly decent returns, and because of the currently the scale at which it is growing, you probably get very strong returns, but you need to work the
And
process.
execution is the key.
Execution.
As you said.
Healthcare is completely in the
an
Indian
execution
space. There's not that much of innovation, but it's clearly an execution play. So you have to sort of be good at execution and focus on profitability. I think that's the critical part.
Excellent, Mayur.
Thank you.
Thank you again.
Thank you.
And we look forward to continuously engaging with you and your portfolio company.